Okay, well, here's some information about the SoFiE Seminar Series, the main one being the web link at the first item on the screen. Okay, well, welcome everybody to today's SoFiE Seminar. I'm Andrew Patton, the organizer of the series, and today I'm very happy to have Claudia Moise from the Fuqua School of Business at Duke University as our speaker, and her discussant is Joel Hasbrouck from the Stern School of Business at NYU. We'll follow the same format as in all the other seminars so far. We'll do 40 minutes for the speaker, 10 for the discussant, and then 10 for questions and answers at the end. Though if either one of the speaker or discussant runs a little over, I'll be generous on the timekeeping. If you have questions during the talk, you can either use the raise your hand button at the bottom of your Zoom screen, or you can use the Q&A box to type your question in, and I'll default to calling you to ask your question. But if you would rather me ask it on your behalf, if you have a microphone issue or something else, then just put that in the question or the chat box, and I'll do it. And with that, I'll turn it now over to Claudia. So Claudia, take it away.
Thank you very much, Andrew. I'm grateful for the invite to present my work in this great seminar series. So what I'm going to talk today about is the high frequency arbitrage and market illiquidity. So why look at liquidity? Liquidity is essential to the economy because it contributes to the efficiency of financial markets, and it allows them to perform as designed. And liquidity has improved over the past 2 decades, which is partially due to structural changes such as the move to decimalization in the trading process, the increase in the alternative trading systems, which practically provide alternative channels for accessing liquidity, the growth in electronic communication networks, and all kinds of other financial innovations. So what happens in normal times? In normal times, there is plenty of liquidity and assets trade close to their fundamental values. In contrast, during times of market stress, liquidity is scarce, and as a result, the law of one price breaks down and assets end up trading away from their fundamental values. So if arbitrage capital were to be readily available, arbitrageurs could come into the market and arbitrage away these price discrepancies. However, during times of market stress, the arbitrage capital cannot be easily deployed. So this slow move in arbitrage capital basically leads to excessive fluctuations in prices, which are short-lived, but are important. They capture this trading of assets away from their fundamental values. And as Darrell Duffy pointed out in his presidential address, even in extremely active markets, such as the electronic limit order book market, price dynamics reflect slow move of capital when viewed from a high frequency perspective.
Yeah, can I just ask, I can't see your screen.
Oh, I'm sorry.
That's okay. I wasn't sure if you were doing a nice verbal introduction to the talk. Now I can see.
Can you see it now?
Yes.
Great. Thank you so much. Yes, I just covered the first slide. Okay. So, as I said, the slow move in arbitrage capital leads to excessive price fluctuations. They are non-fundamental in nature, they are short-lived, they lead to transitory volatility. So transitory volatility is important in the markets, and it has been shown to undermine the stability of the securities market. It basically reflects difficulties in the market-making mechanism, and it signals the vulnerability of the liquid automated markets to severe price dislocations. And basically, transitory volatility has triggered regulatory responses, which are designed to guard against this extraordinary transitory volatility. So basically, after the flash crash of May 6, 2010, when an event when basically between 2:40 p.m. and 3 p.m., over 20,000 trades across 300 securities were trading at 60% or higher price compared to their 2:40 p.m. Value before returning to the previous price at 3 p.m. So during that, so that type of event actually triggered regulatory responses that implemented stock level circuit breakers in the market, which were followed later by price limits. This is what we have in place right now. It's a limit up, limit down type of system. So what I'm saying is that transitory volatility is important. It has been of concern to both investors and regulators for some time. And my objective here is to show that it's of first order importance and captures liquidity in the market. So basically the approach is the following. The observed price has two components, two latent components. So the transaction price has a fundamental component, which is permanent, occurs during the price discovery process. It incorporates new information regarding fundamentals into asset prices, and it will prevail in a frictionless market. The second component is a market microstructure friction component. This one is a transitory component. It reflects the existence of trading frictions, and it may be attributable to the demands of impatient, uninformed traders or the inventory risk exposure of financial intermediaries. And this type of model is not new, so it can be traced back to the work that I post here at the bottom of this slide. So what I do in the paper, I basically combine continuous time econometrics with market microstructure theory, arbitrage arguments, and I use ultra-high frequency data to extract the market illiquidity proxy. This proxy is based on the transitory volatility of spiders. The trading ticker is SPY. Spider is an ETF that tracks the S&P 500 basket of securities. Then I provide economic support for this measure. I show its novelty and evaluate its pricing ability at the end. Okay, so as I said, I use high frequency transaction prices on spiders. Spiders can be redeemed or created in exchange for the underlying basket of securities, and arbitrage forces keep them in line with fundamentals. So as Elton, Gruber, Comer, and Lee pointed out, the ability to create and destroy spiders acts as a very effective mechanism in keeping price close to NAV, to the net asset value, at any moment in time, and assuring that any differences between the two disappear quickly. So spiders trade with negligible price premium or discounts. Also, deviations from the NAV signal that there are market frictions that render arbitrages harder to implement, as pointed out by Engel and Sarkar. So the size of these deviations depend on aggregate liquidity. So aggregate liquidity affects the deviation between the spider and the NAV, as well as the deviation between the transaction prices for the S&P 500, which determine the NAV, and the fundamental value. Now, because NAVs are stale, but more importantly, NAVs are computed at transaction prices and prices include liquidity, what I do here, I look at the deviation of SPY transactions prices from this latent fundamental value that I mentioned earlier. So I'll give you an example of an arbitrage in the market. So this is a picture from the BlackRock report on the August 24, 2015 flash crash. And what happened during that day? So in the morning, there was a large order imbalance. Basically, investors were reacting to overnight news on macro uncertainty, global macro uncertainty. And the circuit breakers that were in place were triggered. So there were lots of trading halts in the morning. And as a result, well, because practically the ETP is an exchange traded product. So ETPs rely on market makers to arbitrage away the discrepancies between their share price and the underlying basket of securities. And during that day, so in the morning of that day, because of delays in opening, the trading halts triggered by circuit breakers, uncertainty about the hedging position to take in the market, so practically market makers did not commit capital and refused to provide liquidity in the market. So this is an example where you see this, an ETP trading here at a discount compared to the underlying basket of securities. So here in the blue line is the index price, the green line is the ETP price. Okay, and I should mention here. So in my earlier communication with Joel, Joel raised the point that the ETF arbitrage eliminates the price difference between the ETF and the underlying index. It does not bring the ETF or the underlying index back to the fundamental values. And he's absolutely correct. So basically what you observe, the observables are the price of the ETF and the underlying basket of securities. That's what we see in practice. Okay. Now, data sources, monthly and daily chart. I have all the features described in the paper, and I don't have the time now, I'm afraid, to go through all the details. So everything is described in the paper. I basically use transaction prices from the primary exchanges, NASDAQ, NYSE, ARCA, BATS, and FIRA NDF. And data starts in February 2001, ends with the latest, but I had at the time, December 2019. So basically, the spiders were introduced to the markets in February 93. However, there wasn't much trading in spiders in the 90s, and I need so to capture illiquidity in the market, I need a liquid measure. That's one reason why I start February 2001. But why February? Well, because decimalization was implemented in the markets in 2000, 2001. Spider is an IZ ARCA listed security, and for these securities, decimalization actually was finished. So the transition to decimalization ended in at the end of January 2001. So this is what why I had this data set. So practically, I want to keep one liquidity regime as well. Okay, so looking at the high frequency price formation, P tilde here is the observed logarithmic price for the spider. It has two components, as I mentioned earlier, P, which is the fundamental component, and upside, which is a deviation component. So basically, the fundamental component, the fundamental price P, is the solution to the stochastic differential equation that we see here, where phi is a continuous predictable drift process. Spot volatility, sigma, is a Cadillac process, so it's a right continuous limits everywhere process. W is a standard Brownian motion. The price deviations are assumed to have zero mean and a bounded fourth moment. Now, the fundamental and the deviation process can be assumed to be independent, but actually, from a microstructure point of view, it makes sense to allow non-zero correlation between them. So I'm going to work in this less restrictive setup. Now, if I divide each day into m subperiods, with delta being the distance between observations, so practically delta is h over m, but h is equal to 1 here. I have 1 day. So I can write the fundamental price process as following this stochastic, continuous stochastic martingale, and observing that at ultra high frequency, the drift psi becomes insignificant both from a statistical as well as an economic perspective, the fundamental log return ends up having this expression here. Now, if there are no frictions in the market, then the quadratic variation, the realized variance, converges in probability to the integrated variance. If frictions are present in the market, then there is this substantial noise accumulation at ultra high frequency. And here we have basically a very influential literature on realized volatility. And I listed some of the papers, more recent papers here, where basically the idea is to estimate the volatility of the fundamental process by purging the microstructure frictions. And my focus here is actually on this friction process and more specifically on its volatility. Okay. So as said, the observed price P tilde is composed of a fundamental price and the deviation price component. Correspondingly, we have the observed return being a sum of a fundamental and a deviation return. Okay, so now I'm going to make the classical assumptions where the deviation return has a stochastic order of magnitude big O of 1, so it's bounding the probability by 1. The fundamental process has a stochastic order of lower magnitude, big O of square root of delta, where delta is basically 1 over m. So what happens here is that regardless of the updates to the fundamental price process, there are non-negligible adjustments to the prices that occur over small intervals. And this is due to the bid-ask positioning of the dealer, to price discreteness, for instance. So what happens is that the price discovery process occurs at a lower frequency. And when sampling the data at the ultra high frequency, this deviation return process does not vanish. Okay, so now let's look at this equation here. I'm going to compute the variance of the realized returns, which is the variance of these two return components basically a sum of two variances and the covariance. The realized counterparts are the ones that you see here on the bottom, where the first and the third terms here are bounded in probability, and the second one is bounded almost sure. So what I'm going to do next is I'm going to divide this equation by MT, the number of observations, the daily number of observations, which you see that M, so M has a subscript here indicating that it's time variable. And I have on average just over 14,000 observations per day. So I divide by M, and then I take the limit as M goes to infinity, which gives me the result that you see on the next slide. So basically what happens when I divide by M and I take the limit, the variance of the fundamental process is swung by the variance of the deviation return, and the cross term is also stochastically dominated by this variance of the deviation return. So by sampling the data at the ultra high frequency, I can identify the variance basically of the return deviation, which is twice the variance of the cost of transacting the spider. So what I'm going to do, I'm going to propose the market illiquidity factor, which is the square root of this quantity here. It's expressed in percentage. So this can be generalized. So I have the monthly measure here for a month K, but has capital T trading day. Also because there is a very large number of observations in spiders trading these days. Practically, if you look at TAC, the spider is actually reported at the microsecond level. So basically, this measure can be also computed intraday over shorter horizons. Good. Now, the next step is to look at look at the relation between the proposed factor and stock level illiquidity. So the cost of buying or selling a share of stock in a stock S in the S&P 500 basket at some time J during the day T is again the difference between the fundamental price, between the observed price for that stock and its fundamental value. I can rewrite this as 1 minus 2 times the sell indicator. The sell indicator is not stock specific, so basically it reflects the selling or buying of the basket of securities times psi star, which is a positive value. So now the cost of trading the S&P 500 is basically the weighted sum of these individual costs. Well, the weights actually are the ones that that the stocks have assigned in the S&P 500, which I can write this way. And next thing, I'm gonna look at the variance of this cost. And you can find in the paper that the result that the variance is equal to this formula here, which breaks down in two components. So basically, I have a variance and a covariance component. Okay, I'm sorry, my power, I have a power problem. I don't know why. Okay. Okay. So basically what happens is that we have empirically has been documented that there is commonality in liquidity. So in other words, this covariance term is non-zero. This is important. So now, as I mentioned earlier, aggregate liquidity affects the deviation between the spider and the fundamental value, as well as the deviation between the transaction prices for the underlying basket of securities and the fundamental value. So it is expected that the deviation for the spider is positively related to this weighted sum of deviations. So in other words, the spider deviation does not have to track one for one this quantity, but as long as the two are positively related, then the variance of the price deviation for spider, which is practically the transitory variance of spider, captures this commonality in liquidity, and not only that, does a better job in capturing.
So resuming the recording. There was first question from Pankaj Jain. So let me unmute you and you can go ahead and ask your question. That may be a microphone issue. So I'll just read out, he typed in his question. So he asked the question, whether arbitrage is between equity exchanges. So this was from a few slides ago.
Say again, either what?
Yes, he asked whether the arbitrage is between equity exchanges.
So he thinks about fragmentation in trading for the spider. No, the arbitrage is between the value of the spider and its so the transaction price and its fundamental value. So in reality, the arbitrage happens between the spider and the basket of securities that we saw that arbitrage occurring during the mini flash crash in August 24, 2015. But in the context of this of my model, basically the arbitrage is between the transaction price of spiders and its fundamental value. Transaction price.
So the data does not include the futures prices. In other words, what you're examining is from exchanges, equity exchanges only, right? The ETF.
Correct, PK. Yes. So alternatively, one can do an exercise where you can look at the deviation between the SPX, the future on the spider and on the S&P 500 and the underlying the fundamental value as well. A similar exercise. Yeah, but I do not mix the two. That's correct.
Thank you.
Mm-hmm.
Okay, great. And the other question was from Marcelo Fernandez. Marcelo, would you like to ask your question?
Sure. Thanks, Andrew. So it's just to clarify, the clarification question. Is it fair to say that you implicitly assume that the contribution of the microstructure error to the quadratic variation is completely driven by the liquidity issues? I think this comes from slide 14, the previous slide.
Yeah, in the presence of microstructure frictions here.
Yeah. So all the
basically on this result, yes.
Yeah. So all the microstructure frictions are coming from liquidity issues.
So the microstructure frictions, they're related to the frictions in the transaction process, basically, because this is, I'm looking at an index, there is no room for asymmetric information here, if you are thinking that way. So yes, we are liquidity driven. Yeah.
Thanks.
Mm-hmm.
Okay, so please continue, Claudia.
Thank you. And again, I apologize for the drop in power. Okay, so I got to this point where I basically pointed to the theoretical relation between the volatility, so the transitory volatility in the spider and the co-movement in the commonality in stock level illiquidity. Okay, next slide, I show the daily MIR. So MIR stands for market illiquidity. So this is the daily measure, and this is on the next slide is the monthly measure. So you can see that MIL fluctuates during recessions and financial crisis. So it's reassuring to see that it's actually larger during bad times. As decimalization got completed, you can see here basically the increase in liquidity that happened during the early 2000s. So, and basically this is captured by this decrease in illiquidity. Okay, so the next step is to look at the relation between the proposed factor and existing market illiquidity proxies. So I'm gonna use here Joel's two common factor series for effective cost based on TAC and CRIS data. So I call them HC, TAC, and HC. The Hupon and Wang measure, which is basically an average of price deviations from the fundamentals in the treasury market, denoted by HPW, the Pastor-Stonebath and the Amihud measures as well, which are average of stock level liquidity. Okay, Pastor-Stonebath is a liquidity measure. The rest are illiquidity measures. So I look at the dynamics in time series for these illiquidity proxies. So for the longer series, you see the plotting on this slide. Next slide has the shorter series. The series that ended in 2005 and December 2005, and then the Pastor-Stonebath that ends in December 2018. So most series actually display this increase in liquidity at the beginning of the period, and all of them tend to move together. So they are more volatile during bad times. It's nice to see that the MIL series, which is the green line, tends to move together with the other series. So it captures a similar phenomena. However, when I look at the cross correlations between these illiquidity proxies, both daily and monthly frequency. So a daily frequency, I only have HPW and Joel's two measures. The largest correlation is with Joel's CTAC measure here. So also keep in mind that the HCTAC and HPW as well as PS are shorter series. So it's nice to see that there is a significant correlation between these series, but it's not perfect correlation either. So this is good. Also, the PS measure, being a liquidity measure, has a negative correlation with the rest. Okay. So the next step is to look at what liquidity measure. So basically, market liquidity is a useful metric for assessing market quality. And market quality is affected by political uncertainty. So during uncertain times in the economy, while market makers may hold low inventory, at the same time they are exposed to information leakage, and as a result there may be risk of information asymmetry and adverse selection. So I expect liquidity provision to go down during such times. So I practically do a test where in a linear regression, I regress daily changes in the proposed measure on daily changes in the political uncertainty index of Baker, Bloom, and Davis. And I find that indeed, when when uncertainty increases, there are increases in illiquidity. So liquidity drops. Good. Next step is to do an empirical test where I test the relation between the proposed factor and commonality in stock liquidity. So basically, I want to address a concern here, a possible concern that spider volatility actually just captures idiosyncratic events to spiders. So what I do, I perform time series regressions where I regress the daily change in illiquidity at the stock level as captured by the relative quoted spread here. So I regress this daily stock illiquidity on daily MIL, actually changes in daily stock illiquidity on changes in daily MIL. And if for MIL to be capturing commonality in stock illiquidity, I expect the majority of the slopes in these regressions to be positive. And this is what I see. So 90% of the slopes are positive, 63% are also significant. For the HPW, so here I present the results for the series that are available for the longest duration, for the longest sample. HPW has 51% of the slopes being positive. So basically, I'm looking at the mass of the distribution of these statistics and see if it's to the right of the cutoff point of 1.96, which is indeed the case for delta MIL. So what happens with HPW? Basically, when I look at the cross correlation between MIL and HPW with TED, so TED is the difference between LIBOR and the risk-free T-bill, I see that my measure, so the proposed measure has only a 19% correlation with that, while the HPW measure has a 60%. So in other words, the HPW measure is a great measure for funding liquidity, which may explain the results on the previous slide. Okay. So the next question is, well, is MIL actually just a manifestation of other common risks? So what I do here to show the novelty in the proposed measure, I look at regressions of daily changes in MIL on daily changes to the existing liquidity proxy. So daily changes in HPW, in Joel's factors, and also because during turbulent times, as captured by increased VIX, Nagel points out to an evaporation of liquidity. So I also check if it's just a manifestation of VIX. And it's good to see that actually this liquidity or bedtime proxies only explain low percentage of the variation in the proposed measure, which is reassuring. So, and it's supportive for its novelty. Okay, and next step is to look at the asset pricing test. So what I do here, I need to build a tradable MIL factor. And basically here, so I do an exercise at the monthly level, and I have all the details of how I construct the portfolios. They are basically 2-year rolling windows over which I run this regression here. So I use the shocks, the innovations to illiquidity, which is basically a residual from an AR1 time series applied to market liquidity. And then I project the MIL factor on the spacer returns, basically by building a strategy where I go long on the first portfolio and short on the 10th portfolio. So I take the difference between the value-weighted returns on these two portfolios. And I find that the premium on this traded factor is equal to 8.64% per annum. So what happens is that, so remember, this tradable factor goes long on the first portfolio, short on the 10th portfolio. The first portfolio is the portfolio of stocks that have a negative beta MIL estimate. So these are stocks that during bad times are also double penalized by having negative exposure to MIL. So they are perceived as riskier by investor, and they require a premium for holding them. While portfolio 10 has stocks that have a positive exposure to IMIL, so have a positive beta IMIL estimate. These are stocks that have a positive exposure to market liquidity risk, which means they pay off during bad times. Therefore, they're a hedge and investors are happy with lower returns. So this explains this premium here. Okay. And next step is to look at whether this factor can be explained by existing risk factors. So I do spanning tests in the spirit of Barillas and Schenken. And basically what I do, so what you see in this table are monthly results. So practically the premium for the traded factor is equal to 72 basis points per month. And in all these regressions, so I use CAPM, Fama-French 3-factor model, Fama-French 5-factor model, where on top of the proxies for size and book to market, I have also operating profitability and investment proxies. And finally, I add momentum as well to the models. So in all these scenarios, we can see that basically the abnormal return increases. So the Fama-French 3-factor has a 94 basis points per month. Fama-French 5-factor plus momentum has a 98 basis points per month. By the way, so all these are multiplicity adjusted p-values. So I correct for multiplicity tests here. And I also look at the existing liquidity process. Do they span the existing, the proposed factor? So I add here the changes in the HPW, in the Hupanen-1 measure, the Amihood residual, and the traded Bastro-Stambach factor, and finally changes in VIX. So in all these scenarios, I see that basically the abnormal returns is larger. So practically this, so existing risk factors, including existing liquidity process, do not explain the return that is due to the proposed factor. So they do not span the proposed factor. Okay, so in conclusion, what I do here, I use an index and I use no arbitrage arguments and market microstructure theory to propose a market illiquidity measure, which is based on the SPI-just transitory price volatility. I show that while this measure relates to existing illiquidity measures, it's not, it's materially different from them, it's not spent by them. And an investment strategy based on the proposed factor earns an annual premium of 8.64%, which is not explained by classical risk factors, including existing liquidity measures. Okay, so at the end, why go through all this exercise? So what do we gain here? Well, in contrast to existing aggregate liquidity measures, this factor does not require firm level trading volume. It does not aggregate stock level illiquidity, while at the same time, it captures movement in stock level illiquidity. Also, An illiquidity measure can be easily constructed over shorter intervals within the day based on the high availability of the SPAD, which is a highly liquid asset. And finally, this is a real-time measure of liquidity, which may prove helpful in predicting flash crash types of events, as of the type that I showed you, for instance, like the August 24, 2015 flash crash. Thank you. I hope I finished on time.
Perfect. Yes, you did. Thank you very much, Claudia. Thank you. Well, there's a question or two from the audience, but I think the right thing to do might be to move on to Joel's discussion, and then we'll do all questions.
Okay, perfect. Perfect.
So the floor is yours, Joel.
All right, thank you, Andrew. And are my slides visible?
Yes.
Yes.
Excellent. Claudia, thank you for a very clear presentation. It certainly makes the discussant's job easier. And thank you also for a very graceful recovery from a technical presentation disaster, which, believe me, all of us can sympathize with. Now, to frame my remarks, I'm going to just repeat or summarize some of the statistical assumptions we're making. So the world is one in which our observed transaction price is broken into a fundamental martingale type component and a stationary deviation, variously called, I guess, for purposes of this seminar, the microstructure noise. And the statistics are based on the infill asymptotics, which is we take a unit interval of natural time, think of it as a day, and we're going to progressively refine the intervals at which we sample. And at the end of each interval, we're going to observe a price, and from those prices, we'll construct a realized variance. And as the number of intervals gets large, or equivalently as the width of each interval goes to 0, the realized variance becomes dominated by this microstructure noise. And this is a long-standing theme in the realized variance literature. One of my favorite early works is the volume in the Journal of Business and Economic Statistics, taking off from the Hansen and Lund paper with many, many comments and a rejoinder, which is a good introduction to the whole topic. And in particular, if we wanted to specialize this to the case of IID deviations, then this realized variance would converge to twice the variance of the microstructure noise. Now, the change of perspective here is this. Usually in these kinds of analyses, we're trying to characterize the dynamics, maybe the volatility of the fundamental price, and this microstructure noise is just really a nuisance. Here, it's the main event. It's what we're trying to get. And we're applying this view to the SPY, which is, of course, the ETF for the exchange for the S&P 500. We're going to construct windowed estimates of the realized volatility, and this then becomes our market illiquidity measure. And we're going to use it for a couple of purposes. One, it's a very convenient summary measure of market-wide illiquidity. But also it's a medium frequency, and by that I mean either daily or monthly, estimate of the illiquidity factors. And we can use it then to construct liquidity betas for our individual stocks. Now, in order to make this persuasive, we need to establish a couple of connections. One, a connection between the realized variance and liquidity. And really, there are a number of stories we can appeal to here. in the narrowest interpretation I can think of is that psi is simply bid-ask bounce. And in that case, its variance, or the market illiquidity measure, would map to the spread, which is a very direct and plausible measure of the trading cost, at least for some participants. But Claudia here is encouraging us to take a broader interpretation of all kinds of mispricing things in this world that would be eliminated except for impediments to arbitrage. And these are not just liquidity costs, but also the costs of arbitrage capital and barriers to entry, giving us slow-moving capital. So in this broader interpretation, this mill is picking up a wide range of trading costs, but either the narrow or the broader interpretation, we can get time and cross-sectional variation, picking up time variation in the underlying economic contributings. All right. But how should we think about arbitrage in this sort of world? Well, often when we write down these kinds of models, we think of arbitrage as something that is going to be pushing the deviation to zero. So the fundamental price is like an efficient price, and it may be a conditional expectation of some terminal value or terminal payoff. And when we're talking about elimination of this deviation, it can be arise from an informational kind of efficiency. But the point is, to push these kinds of deviations to zero, you often require a very substantial commitment of arbitrage capital that's going to be tied up for a long period of time, and it might well be levered. So if you want to do spot futures arbitrage or covered interest parity arbitrage, you're talking about lots of money over a long period of time. ETF arbitrage is different. We're not eliminating a fundamental valuation deviation, but we are eliminating a relative mispricing. But the important thing about this kind of arbitrage is that it's cheap, it's simple, and it's fast. Really, all you need is access to markets. Your capital is only tied up for that period of time over which you're implementing the trades. So that's quite a bit simpler. Now, the other thing we need to make this story plausible is the connection between this market illiquidity measure and the common components of the liquidity in the individual stocks. And why would we care about establishing this? Well, it's an easy thing to estimate a daily realized variance of the SPY. SPY is very frequently traded, and if this realized variance is a plausible proxy or measure for the common factor, well, that's a lot simpler than estimating the 500 or so realized variances for the individual stocks. Some of them aren't going to trade very often, so we'll be smoothing over missing data here and trying to average or extract some kind of principal component. So that's the hard way of doing things. If this proposed method works, it's going to be a lot easier. So more rigorously, what is the connection? Well, we can think of the deviation for the SPY as being the portfolio weighted average of the individual deviations. And we can relate the variance then of this SPY deviation to the weighted average W prime omega W, where omega is the covariance of those individual deviations. Now, you might think it would be a good idea to extract the liquidity factor as the first principal component of that. But if you do that, you're going to pick up mostly commonality in the trade directions. And this may be desirable because it is a source of commonality. And the paper gives a very good analysis of that kind of commonality by explicitly assuming and making some restrictions on the trade directions. But as an alternative, if we're thinking about time variation and liquidity over, say, daily or monthly intervals, maybe it is simpler to get by just putting in some kind of time varying scaling factor in attached to our omega matrix. So that's not going to pick up commonality at the high frequency level, not at the intradaily level, but maybe that's not what we're looking for. And then in the empirical analysis, Claudia presents some very persuasive evidence. She shows it's correlated with the market-wide liquidity proxies. Not perfectly correlated, though. There's some novelty here. It explains the commonality in the individual stock liquidity proxies. It's sensibly related to policy uncertainty and funding liquidity. All of these things make us more convinced that it's picking up what we would like it to pick up. Is it a priced risk factor? Well, following a practice that's pretty standard in this literature, Claudia forms the Innovation Series, projects that series on the full space of stock returns, constructs liquidity betas, forms high-low deciles, and the implied risk premium on this risk factor is about 8.5% annually, which is reasonable and pretty plausible. All of this is very good. The problem is the ground has shifted on us in two respects. One is, since those first liquidity papers were written, there's been a big proliferation of new asset pricing factors of all kinds. Cochrane memorably called it the factor zoo. Now, in this zoo, I don't know whether our liquidity factors are up there with the lions and tigers, or if they are in the reptile house, but whatever it is, there are a lot of factors and it's difficult to differentiate among them. The other thing that's happened is that the nature of equity trading has changed. Since those early papers were written, trading costs have come way down and variation in those costs has come down. Now, if we go back to those papers, and they have been replicated and extended, turns out the replications in the original samples pretty much work out. So the original authors didn't make any big mistakes there, but in extended samples, the liquidity risks are weaker and they're more fragile. For a good introduction to this, I'd commend to you Critical Finance Review, Volume 8, 2019, which looks at many of the tests from Pastor and Stambaugh, Amahud, Acharya Pedersen, and so forth, and collects those with new examinations, rejoinders by the original authors. It's an exemplary dialogue in what's changed. So where does this leave us with this paper? First, the big question here is the realized variance of an index ETF a reasonable summary measure of market-wide illiquidity? I think the paper has established this. Is it a price risk factor? I think it probably is, but I don't think I could prove that to a skeptical asset pricing person. So instead, I might be inclined to look for other applications. The same issues that arose in equities are going to arise in bonds and bond ETFs, which are much less liquid, and the markets are much less tightly integrated. So I think this kind of measure could be a great tool for looking at market-wide liquidity dynamics. And also, we think of the index ETF being on the one hand, or the one end of the spectrum, and the component stocks being on the other. But in the middle are the sector ETFs. And there are maybe about 9 or a dozen of them. And they have their own liquidity properties. And I think it might be useful to look at a hierarchical or a cross-sector model of liquidity. In any event, I think this paper is a great start. It teaches us a useful way of looking at realized volatility of index ETFs. And before I try your patience anymore on my time limits, thank you, and I will stop here.
Okay, thanks very much, Joel. Yeah, I was happy to let that run a little late, given all the great comments you were raising. So let me turn it over to Claudia to respond if you'd like to.
Yes, thank you so much, Joel, for the time and effort that you put in the discussion, and the fantastic comments that you gave me. They are super helpful. I greatly appreciate your help. So to address some of your comments, and I may need to get back to you on some things. Talking about the alternative model, with where you propose using this ZT, that with a daily scale factor for the covariance, cross covariance model. I'm wondering if, so you mentioned something that there is at a daily frequency. I'm wondering if something like dealer capital will play a role here, if that will be a good candidate, maybe, for that model. Regarding the asset pricing test, yes, I am aware that it has become more challenging to propose and publish a paper that comes up with a new factor. So the threshold is much higher these days, and well, lucky me. But I hope that I can convince that future referees that the measure is theoretically derived, and it's also empirically supported by events that occurred in the US financial markets. And not only that, but transitory volatility actually triggered regulatory responses that were basically reshaped the trading mechanism in the US markets, and practically attempt to diminish this the occurrence of these episodes with extraordinary volatility in order to keep markets liquid and operating as desired. So, but that being said, if anybody has any suggestions on how to strengthen the asset pricing part of the paper, I would love to hear them. And I love the suggestions that Joel made here. So bond and bond ETF. So yes, there is a big concern about liquidity in the bond market. So that's definitely a space that is interesting looking into. We don't have a mechanism like we have in the equity market with these circuit breakers that are basically transitory volatility motivated. But still, I can look and do an exercise in that market as well. And this cross markets liquidity dynamics will be very, very interesting to analyze. And I also like the idea with that hierarchical model of liquidity. Yeah, so we have sector level ETFs and which are highly liquid as well. So a similar exercise can be performed on this ETFs as well. So these are excellent suggestions, and I'm very grateful to Joel for making that.
All right. Well, Claudia, let me turn it over to Cliff Herbert. Had a question during your talk, but I put it off until this section. So Cliff, if you would like to unmute and ask your question, you can.
Okay, thanks a lot. I have a couple of questions for you. I'm looking at the modeling aspects, the probabilistic modeling aspects of your work. So you're saying you want the deviation to be transitory, but you still want it to dominate the realized variance. So I'm wondering if anyone has actually proposed a continuous time model for the log price as opposed to the returns where this is going to happen.
Okay, so I'm working with returns because I need stationary variables as opposed to prices. Yes. So this
but you just you write down the assumption on the returns, but I would be interested to see what the model looks like in continuous time if you have a specific model there.
So basically, for returns, if you are you thinking about an asset pricing model or just structural model for volatility? What do you?
Well, you write down part of your equation, right? You have a sigma t dw, right? That's for the fundamental part. What is it going to look like for the deviation part?
Okay. That's what you refer to. So practically, what happens here? I don't. So first of all, these deviations are assumed to have mean zero and a bounded moment. I don't assume that ID because I need from a microstructure perspective to have a correlation, so allow for correlation between fundamental and deviation process. So I do not have a model for this deviation. So basically, if you think about, and I'm not aware of a model. If anybody has any suggestions, I would love to hear them. But basically, these are just price deviations that occur, so they are temporary. I don't have a model for them. It's
okay. Can I just have one more quick question for you. There's a lot of empirical and theoretical evidence going all the way back to the papers like Anderson, Ballerslev, Diebold, and Labies that realized variance has the long memory property.
Mm-hmm.
Right? So I think this is fairly well accepted in financial econometrics. It's a property of realized variance. So that means your illiquidity measure is also going to have that property. And so this creates certain statistical issues. So for example, if you try to measure cross correlations among time series that have long memory, then you can't use the usual kinds of standard errors that are coming out of your statistical package to assess statistical significance. I understand. I'm sure you're not the only person doing this, and I'm speaking as a statistician here, right? But I just want to point out that that long memory, which is well established, then needs to be taken into account when you're trying to learn from the data.
Right. So these are excellent. So very good points. So Marcelo, yes, you're thinking about the long memory in the realized variance. Now, if we look at the way I identify the market illiquidity, it's actually an average realized variance. It's an average second moment. It's not just the second moment. And this average changes on a daily basis. So basically, in the paper, that's equation 13, I show that the average second moment were empty, so that the denominator varies widely. That average second moment actually identifies.
But it is a realized variance, is it not?
It identifies, yes. So the volatility, the transitory volatility. So this measure, it captures transitory price moves. How do I identify it? Well, by taking not the realized variance, but it's an average of the second moment. If you look at the equation 13 in the paper.
Okay, I'll take a better look. Thank you.
So, but I'll have to think through because you made some important points as well. Okay. I have to think. So maybe a way to look at that.
We've got a couple more questions, but I think this is a good time to move to the post-seminar hangout session. So let's do that. I see Marcelo and Steve Figusi have questions, but please join us in the hangout. But before we leave here, let me do a brief advertisement for the next SoFiE seminar. The next SoFiE seminar will be in 2 weeks' time, and our speaker will be Caio Almeida from Princeton University, and his discussant will be Torben Andersen from Northwestern University. So let me thank Claudia and Joel for a great seminar today. I really enjoyed it. I hope you guys did too. And if you would like, please stick around and we'll meet again in just a second. If not, I'll see you all, I hope, in 2 weeks' time at the next SoFiE seminar.